All right, it's time to get started. Great to see you. And I'm wearing my special valuation masterclass boot camp hat. For those people who have attended the boot camp, you know what that's about. Well, it's great to be here, and we're gonna cover a lot of stuff tonight, and I hope that I get a lot of your questions. Obviously, the markets are going crazy, so it's a good time to get together and talk about things. So remember, say hi in the chat, and also, in addition to that, ask all the questions that you have in the chat. I'm going to be happy to answer the questions. So we've got 62 people in the chat, and I want to just get a few more people in, and then we're going to kick off. So hopefully you're having a good evening. I just had dinner with my mother, and she's lovely, and she's enjoying dinner and a nice glass of wine, which she's really enjoys. Salaya, good to see you. Welcome to everybody. Please say hi if you're on and you want to chat and join the conversation. Tanat, hello. Good to see you. On, I guess you guys are on from YouTube. I know we've got people viewing from different mediums, from Line, from YouTube, from Facebook. So welcome everybody. Make sure that your question and your comment area works so you can send in your questions. I'm thinking that there should be a lot of questions today because, well, there's a lot going on. AK says, hello, Doc. Nice to see you. Nice to see you. Puntrick says, good evening, Ka. Good evening to you too. I was saying I just had a nice time with my mom, and now I told her I got to go live and talk about the portfolio. So let's get started. I'm going to start to share my screen. We're up to 88 people, and let's just see this group continue to grow, and feel free to ask questions all throughout. If you get any question in your head, just type it in immediately. I may not answer it right then, but I will answer it at the end. So please put any questions in as we go along. All right, so this is the all-weather strategy, and we're reviewing the performance of May, and we'll look at the performance also since the end of May and take all of your questions. So hi, there's Weirot. Nice to see you. Weirot, nice to see you. Hello. And also Panuchaya, nice to see you. Yep. And Obi, good to see you. And there's my other namesake, Andrew. Nice shirt. Yeah, my mother bought this shirt for me. There's a great tailor in Bangkok named Pinky, and he has his place down at he has that at Mahatun Plaza. So mom always goes there and picks out the fabric, and then he makes it. So that's always a great gift from mom. So mom knows the colors that work. So remember to ask your questions in the chat, and I'm going to answer them at the end. So just keep asking them as we go through. So we're going to review rate hikes and recession concerns, and we're going to talk about the underperformed a 60-40 portfolio by 0.3% in May. And then we're going to also talk about how we increase bonds and reduce U.S. equity. We'll look at the outlook, war in Ukraine, recovery demand, supply chain, those types of things, commodities and gold. And then, of course, we'll cover the risks. And the risk with this particular strategy is if inflation gets under control, well, this strategy is heavily geared towards inflation. If there was new lockdowns, that could slow things down and hurt the performance. And then the central bank tightening could crash the market. And I think it's very possible that the central bank is already tightening in a way to crash the market. In fact, one of the things I've said before to you guys and to the presentations is I don't think the Fed is going to increase interest rates. I still don't think so, because once they start increasing just a little bit, what's going to happen is the market's going to start crashing. And when it does, they're going to have to change their direction. So Weirot says, do you think the oil price, let's just look at this for everybody. Do you think the oil price crisis, when will it end? And the Fed rate will solve the problem? That's a good question. And that's really going to be my first question that I'm going to answer at the end as we get through the presentation, because you'll see some of the answers to your questions in the presentation. Remember, I know that it's painful to see losses in your portfolio. But remember that investing is a marathon, not a sprint. Look at that road ahead of you right there. It's a long road as we invest towards our future. So it's a marathon. By the way, just for a moment, I'll just mention, I know we got some questions coming in. We wrote, asked a question. Puntrick says, what should we do with our US tech, energy, Europe stock? What should we do about everything? That's a good one. Okay, Jack Kit says เมื่อวานนี้เพียงบอก not sure. Yes. All right. So remember that emotional decisions often turn out to be costly. So to avoid this, we stick with our FVMR framework. It doesn't always outperform in the short term, but in the long run, it does. So we create our strategy for decades. That was me when I was a little boy. That was me when I came to Thailand. And that's going to be me when I'm 100 years old. That is what we're thinking. Our aim is to create strategies that perform over many decades. That's really our goal for both all weather and alpha focus. And I have a little surprise that we are going to be bringing something new to you guys over the next couple of months, but I can't tell you any more than that. Supergone, good to see you. I'm looking forward to your questions tonight. Chanya, hello, Ajan. Hello, Ka Ajan. Good to see you. All right, so here is AWS against the 60-40 portfolio. Now, the all-weather strategy was 15.8% above a 60-40 portfolio as of the 13th of June. So we are looking at May's performance in tonight's presentation, but we thought we better update it for where we're at right now. AWS is down 2% year to date, while the 60-40 is down 13% year to date, and world stocks are down 20% year to date. So I would say that, it's good. It's good performance, and I'm happy with it. So hopefully you are too. All right, we have 227 people on this call on the live session. I know there's others coming in from other places, so welcome everybody. And we're talking about the all-weather strategy. Now, here's the central bank dilemma. Basically, inflation is too high, but we can't increase supply of goods, so we need to reduce demand. That means a recession. And that is my fear. So inflation especially hurts the poor. Why? Because people with lower incomes have less bargaining power to raise salaries. Now, Sri Lanka is one example of a country in serious trouble. We've looked at some of this before to try to understand what's happening. And here you can see that Sri Lanka is bankrupt and has only 1 day of fuel. Senegal is out of jet fuel, and also Nigeria. Nigeria is a serious hotspot right now. Also, children around the globe are dying from a lack of food availability because their climate shaming didn't come with a complete understanding of proper incremental energy transition policy. In fact, I would say that tonight's presentation, I would focus on, one thing is that really the policymakers are not nearly as smart as we think they are. They really are messing things up big time. I mean, really seriously messing things up. Now, here is a consequence of underinvestment, and it's starting to show. In the area of petrol in the U.S. has had no greenfield projects since 1977. And brownfield projects added 185% capacity since, but still doesn't offset what has been taken offline. And you just can't turn refineries off and on. In fact, one of the heads of one of the energy companies was saying they don't think that there'll be a new refinery started in America in the next 5 or 10 years. So really, there's a huge constraint that's going on, and it's caused by, ultimately, government. Now, the energy crisis may get worse. The world won't have enough energy supplies, and blackouts are threatening about 1 billion people. We've already seen some rolling blackouts happening through China as an example. It is going to get serious. And we're beginning to see food protests. We saw some in Iran. recently, and continued high inflation could exacerbate inequality and lead to more unrest in the world. I mean, think about it. Politicians shut down the global economy because of COVID. And then that pushed almost 100 million people into poverty. And now the politicians are allowing a war to go on and on rather than negotiate and discuss and have political dialogue between America and Russia. Instead of that, they let this war go on. And when they do that, what they're doing is they're causing a food shortage. And so we now have the risk of as much as 100 million people going into famine in this year and next, as predicted by the World Food Program. So it is serious. Protests have erupted over food. We've identified some countries: Argentina, Peru on the left, Tunisia, which is right next to Libya. Also, what you can see is Sudan, Kenya, Iran, even Indonesia, and of course, Sri Lanka. So we can see more and more of this happening over time. So these are countries where there's been protests over food prices in the past few months. Now, this is fascinating. This particular tweet is showing a chart that I remember when this happened right here. There was a big spike in the bond yields. This is high yield credit spreads. In other words, think about a high yield bond that's paying 6% and government bond is paying, let's say 3%, or let's say 2%, just for simplicity's sake. And that means that the yield, the spread between these two is about 4%. Now, what happened here is that people got panicked at this period of time. This was 2020 when the COVID crisis really hit. And what happened is they pushed up the yield on high yield or high risk bonds up to, let's just say, about 10%. And when they put it up by 10% and the government bond rate stayed at 2%, then what you had was an 8% gap. That is this major gap. You can see it says 800. You could also call this 800 basis points or 8%. And that gap basically showed emergency. The point is that things were starting to explode and implode. And what happened was the Fed came in and they stepped in and they said, we're going to start buying these high yield bonds that had been collapsing. Their yields had been rising. And what the Fed did is they quickly brought the bond market down. Well, look at where the bond market is now. It's starting to rise. That spread is starting to increase. So there are serious risks that are happening in the bond market, and high yield spreads is one way to look at it. Now, I think that as the Fed is increasing interest rates and starting to see things falling apart, they're probably going to have to come in again and buy high yield bonds to prevent them from crashing. Now, US was weak in the past month. That's the month of May. And China rebounded during that time. We can see that China was up between 5 and 8%, whereas basically the US was down, NASDAQ down about 5% and 8%, and New York Stock Exchange down about 5%. So just the opposite. And key European markets were down pretty significantly, as we can see, 4.6% for the European Stock Exchange. Remember, if you want to get access to that, just go to Valuation Masterclass Resources and you can download that. Now, let's talk about the asset class weights. Since March of 2022, we've been 45% in equity. Now, that is a very low level of equity, and we had 25% in commodities and 25% in gold. That is a pretty high allocation. And basically, that performance, when we look at that 45% in equity, 25% was in US and 5% in the other 4 major countries or regions. And that gave us our exposure across the world. Now, I'll reveal the new weights after we've reviewed the performance. So get ready, it's coming. Now, the following review shows performance as of the 31st of May. Here, what we can see is world stocks have taken a hit in 2022. World stocks were up 19% in 2021. And year to date, as of the end of May, they were down 12.6%. In May, world stocks gained, in the month of May, they gained 0.2%. U.S. equity was flat in May. Also, we had a 25% target allocation to U.S. equity, which was up about 0.2% in May. And U.S. equity was the third best performing equity market. Let's look at Europe for a minute to understand what's happening there. We had a 5% allocation to Europe, which was up 1.2% in May. And what about China holding up emerging markets? We can see here that the emerging markets we had a 5% allocation to them, and that was up also 0.3. So May wasn't bad. It was kind of flat. And China's rebound held up the emerging markets in the past month. And then let's take a look at Asia Pacific ex Japan, which fell by 0.3% in May. We had a 5% allocation there. Now, besides China and Taiwan, which constitute about 55% of the index, most Asian markets fell in May. So remember, I know we've got 270 people that I can see on the call. I know some people are calling in from Line and other places. Feel free to ask your question in the chat. If you don't feel comfortable asking your question in English, then feel free to type it into Thai. And between myself and others on here, we'll be able to translate that and get that question in. So feel free to ask the questions. I know we've got questions coming in right now. So Japan was flat in May, and we had a 5% allocation to Japan. And next, let's look at commodities. The money market. The money market stayed flat. Rather than global bonds, we had a small 5% target allocation to the Thai money market, which was flat as expected. The main purpose of our money market allocation is downside protection. And here you can see that commodities were up the most in May. They were up 3.4%, and we had a 25% target allocation. So we definitely got that one right. Commodities have been on a bull run since April of 2020. We can see that energy is one of the major commodity components, and that it is the major component. It's about 60%. And as mentioned, energy prices rose based on geopolitical events related to the war in Ukraine. And WTO closed, the WTI, the oil price, closed at $115 per barrel. Now, also, let's take a look at gold. Gold was the worst performer in May, and we had a 25% allocation there. Gold closed the month at $1,837 per ounce, or down about 3.3%. So here you can see AWS, and in the month of May, we were up 0.2 versus the 60-40 portfolio, which was up 0.5. Now, commodities was the best performing asset, and we were in that. But also, we can see we were exposed to U.S., but also we were exposed to gold, and gold was the worst performer. So we were we got it right, exactly right, and we got it exactly wrong on our two biggest bets. Luckily, we're diversified enough that didn't kill us. Now, AWS has shown a strong performance. What we can see is, except in the past 1 month, AWS has had a higher return and risk-adjusted return in all periods. And the same holds true for the drawdown adjusted return, but it was 0.1 times for both portfolios in the past month. So AWS has experienced less volatility than the 60-40. Mostly, we have a 25 to 65% target weight for equity, and that has reduced the volatility. Since gold is generally uncorrelated to equity, it's reduced the overall AWS volatility too. So AWS has lost less on 9 out of 10 of the 10 worst days. And the key feature of AWS is that we aim to lose less on these extreme days. Of the 10 worst days, basically 9 of them, we ended up performing better than the market's crash. And here we can see that AWS outperformed a 60-40 in 64% of months. In 25 out of 39 months, the all-weather strategy has beaten that traditional 60-40 portfolio. Now, ladies and gentlemen, it is time for the announcement of the allocations. Are you ready? Let's do it. Here is our new allocation. What you can see is we raised bonds and we've reduced equity. We expect equity to remain volatile due to the war in Ukraine. We reduced equity to 25% from 45% and increased bonds to 25% from 5%. That is a major move, and that is the lowest amount that we have been exposed to equity since we started the AWS portfolio. And generally, for any equity portfolio, you don't want to be down in this type of area of 25%. But that's what makes this all-weather strategy unique, is that we can go to this amazing exposure of 25 equity, an equal amount in bonds, an equal amount in commodities, and an equal amount in gold. Now, if the market decides to race up and have a big recovery, then we're going to be hurt. But for right now, we're comfortable with this position. So let's go through it right now. For equity, basically, we've got 5% in every region now. We no longer have the equity exposure in the US. This is a major, major move. This is what we call in the world of finance a material change in our portfolio recommendation. And that's why it's also important to talk about it so that everybody understands what we're doing. And Anu Sabu, you are exactly right. It is exciting. I agree. So we've reduced the US equity, and Federal Reserve Chair Powell said on May 17th, what we need to see is clear and convincing evidence that inflation pressures are abating, meaning going down, and inflation is coming down. And if we don't see that, then we'll have to consider moving more aggressively. If we do see that, then we can consider moving at a slower pace. Of course, he's talking about increasing interest rates to try to stop inflation from rising. Now, the market expects a more aggressive Fed due to record inflation readings. You can see that as of the end of this year, as of the end of 2022, people think that the Fed rate, the Fed target rate, is going to go from where it's at about right now, about let's just say 1.5, it's going to double up to about 3. That's the latest expectation. I think that they're going to be wrong and it's going to come down, but that's another story. The Fed has communicated that it will do what it takes to get inflation under control, though Powell doesn't want to be too aggressive. The rate curve has recently shifted up. Now, here we can also see that the Fed's balance sheet didn't grow in May, and you can say, Andrew, you said there's not going to be interest rate hikes, and you said there's going to be no quantitative tightening. And there were interest rate hikes, and there was a slight amount of quantitative tightening. Remember, if this line is rising, that is QE. That means quantitative easing. That means that the Fed is buying bonds and injecting cash in the economy. And if you see this line go down, that's QT, quantitative tightening, where the Fed is basically taking that cash back out of the market. So some people, the Fed is giving the impression that they're going to do quantitative tightening, but my feeling is they're barely going to come down, and then they're going to have to raise it again over time. And that's why I stand by my argument that I don't think that we're going to see a significant rise in interest rates. Now, I said that they're not going to raise interest rates, but what I would say is that I don't think that they're going to raise very much, or else they're going to see the market crash. So, but remember that withdrawing liquidity, right? When you see that the Fed's balance sheet is shrinking, that's quantitative tightening. That basically is negative for the market. It should cause the stock market to crash. It should, or fall at least, and it should cause the lending market to get much more tight. So again, we reduced the U.S. equity to 5% from 25. Now, European Central Bank President Lagarde blogged on May 23rd, I expect net purchases under the APP to end very early in the third quarter. So the Fed has stopped purchases, but I think they're going to have to start again soon. But here you can see that the ECB did not slow down their purchases. They're continuing to purchase. Remember, every time that the Fed or the European Central Bank purchases bonds, it is giving cash in exchange for those bonds into the market. And that cash, I always try to teach my students that think of a bond as a piece of paper. And when you give a bond, you receive cash. And when you receive a bond, you pay cash. A bond is just a contract. So based on the current outlook, we are likely to be in a position to exit negative interest rates by the end of the third quarter. So she's saying that it's going to be able to tighten later. I think she's terribly wrong in this because Europe is under tremendous pressure because of what's happening in Ukraine. And there's no way they can increase interest rates without really damaging the economy. Now, rate hikes and tightening are in focus. The Bank of England raised its bank rate by 0.75% in May and guided for more hikes. If ECB begins quantitative tightening, it could lead to a recession in Europe. I mean, Europe's already in a recession or a very, very difficult time. And now what we can see is that it could get worse if the ECB raises rates. We keep our target allocation in Europe to 5%. I think there will be a time to invest in developed Europe, but I think we're probably somewhere between 3 and 12 months away from that. So the Bank of Japan wants to keep rates low and is welcoming imported inflation. So you can see that inflation is rising in Japan. The Bank of Japan is the only large central bank in the developed world that wants more inflation. The weak yen leads to higher prices of imports, which leads to imported inflation. So we're keeping the Japanese equity at 5%. Next, the strong dollar hurts emerging markets. I mean, this is a big problem that we're all facing in emerging markets, is that first of all, what happens is the dollar gets strong and these countries' currencies get weak. And because many of the companies or governments are financing in US dollars, it's getting more and more expensive for emerging market countries to buy the US dollars they need to buy the goods and services that they need in their economy. And that's putting a lot of pressure on currencies. We've seen plenty of currencies come under pressure: Vietnam, Indonesia, of course, Sri Lanka, in Pakistan, and all kinds of places. Nigeria is under a lot of currency pressure, and a lot of that has to do with the rise in the dollar. Right now, we have a scarcity of dollars, and that pushes the dollar prices up. So Fed actions are likely to result in a stronger US dollar and less global liquidity, which could hurt emerging markets. US dollar is considered a safe haven, and it can strengthen further as a result of the global turmoil. So there's some theories about the US dollar. One of them is all about the fact that there's a huge market in euro dollars that are being traded outside of the US, and that market is tightening up. And as it does, the demand for dollars rising, and that's causing the value of the dollar to rise. And the Fed during the last crisis basically provided funding out into the euro dollar market to try to quell that strength in the dollar. So we're keeping emerging markets at 5%. Now, China heavyweight matters. Too early to tell if China equity is recovering. The lockdown is very harmful. So some people ask me, is it time for China? Not yet. We are not yet going there. China's heavyweight in the emerging markets in Asia Pacific indices could continue to drag. So we're keeping 5% there. So the increase in bonds to 25% from 5%. Also, market is certain about Fed rate hikes. The point is everybody's convinced the Fed's going to raise rates. On June 8th, the market priced in a 4% probability of a 0.75% hike to a target rate of 1.5. And on June 13th, they priced in probability was 31% for a 0.75 hike and 69% for a 0.5% hike. So people are expecting a hike by the Fed. Now, we've raised our target allocation to bonds to 25% because we see more risk in the markets. Our allocation is to time money market, so a Fed or other central banks rate hike should have little direct impact. In addition, if we were to see rate hikes in Thailand, what's going to happen is that this short-term paper that we're holding is typically less impacted. So remember that we don't get the benefit of baht weakening. Why is that? And dollar strengthening, even though we're investing offshore and we're investing in the dollar, that's because most of the funds are hedged. So you basically are not going to get hurt or gain when it comes to currency on most of the funds that we're investing in. So commodities, let's talk about commodities. We've been in commodities at 25% for a long time. and energy prices remain high. WTI is now at 120. I think earlier I said 115, but it's now up to 120. Europe's Russian energy dependence is going to continue to influence the energy markets. And Russia is also an exporter of metals, and Russia and Ukraine are both exporters of soft commodities. And we can see that they actually have not been exporting those to the world. I just want to mention we have 327 people on the call now, so I want to welcome everybody. I appreciate you being here and taking the time out of your busy schedules to listen to my banter about the markets. Remember that you can ask a question both in Thai and in English in the chat, and I'm going to go through questions in just a bit. So metal prices are high and maybe turning up again. Russia supplies almost 20% of global high-quality nickel used in EV batteries, and the precious metal palladium is mainly used in catalytic converters, and the EU gets more than 40% of its supply from Russia. Here we can see the World Food Price Index hit a record 160 in March and is still at 157 now in May. This is extremely scary, and it is part of the food and famine crisis that is coming, particularly in Africa. Russia and Ukraine account for 15 to 20% of the global supply of corn and wheat. Export bans on food in countries like India and Indonesia could exacerbate food shortages and push prices higher. Now, high energy prices are feeding through to food, whether it's meat or cereals. Basically, we can see that they're rising. Natural gas is used in fertilizer, and high fertilizer costs is leading to higher grain prices. Corn is a primary input for feed grain of livestock and poultry, and that's driving up meat prices also. So it's coming from every angle. Now, commodities are set to go higher, and we're keeping a 25% target allocation. Demand for necessities and supply chain disruptions and the Ukraine war and other things are causing us to say, feel that commodities are going to continue to rise. Finally, there's gold. We've had a 25% weighting. Here you see that we keep gold as an insurance, and it's 25%. The war in Ukraine spurs uncertainty, and inflation expectations could rise, making gold attractive, though expected rate hikes and recession concerns are negative. Now, what are the risks? The risk is that the strategy is still positioned to benefit from rising inflation because we have this 25% commodities allocation. If for some reason inflation didn't rise anymore, well, that would be bad for our strategy and we would start to underperform. So that is risk number one that you need to think about. Risk number two is that a quick resolution of the war in Ukraine would ease the pressure on energy prices. And because we're overweight commodities, that naturally means we're overweight energy. And that would mean that our position in commodities would come down. Now, another risk to this strategy is that the Chinese shutdown reduces energy demand and could lead to lower prices. And finally, the next one is that other commodities could fall with energy prices too, because it's part of the production costs. Also, we could have a global recession pushing down stocks. We could have new COVID mutations. And we've started to see some indications of this global economic shutdown or slowdown. And that could mean that central banks are raising interest rates into a recession. That is a disaster. It's the last thing that the government should be doing. In fact, what we should see is that the government should be lowering interest rates when they're in recessionary times to provide low-cost money and help people get back. But instead, they're doing the exact opposite. So they say that they are Keynesians in that they are following Keynes's teaching that you can use the government to pump up the economy when private consumers aren't buying. But in fact, they're misusing Keynesian economics. And of course, the Chinese lockdown could reduce global demand. And then there's central bank tightening. If major central banks would surprise and not be cautious about rate hikes or QT, it could impact the stock market seriously negatively. And since the U.S. stock market usually has a global impact and the U.S. dollar is the reserve currency, Fed decisions typically have the most impact on the global markets. So what are the key takeaways? Let's review these before we get into Q&A. We underperformed a traditional 60-40 portfolio by 0.3% in May. Since inception, AWS was 15.8% above a 60-40 portfolio as of the 13th of June. Now, the war in Ukraine, recovery demand, and supply chain bottlenecks are driving commodities and gold. And the risk is inflation quickly gets under control, new lockdowns, central bank tightening could crash markets. Now, before the Q&A, just want to highlight that we do have our next valuation masterclass boot camp, which starts on July 25th. Attendees have identified 6 things they've transformed to be more focused and determined. They've learned everything needed to become a successful financial analyst. They've experienced a challenging environment and a supportive environment, and they've gained advanced valuation knowledge. And they were able to focus on the practical aspects of finance and valuation, and they enjoyed my powerful and engaging teaching style. That's what they said. So you can save $700 until July 10th. Just use this coupon code, and you can scan that or go to valuationmasterclass.com/bootcamp and put in Phenomena, and that will give you the discount. And I'd love to see some of my Phenomena friends in there. We've had a lot of people from Phenomena attend. Okay, it's Q&A time. I'm going to stop sharing and go into Q&A time so you can show my face. There we are. All right, so remember, you can ask questions. It's time to ask questions now. I'm going to start to go through the questions. And the first questions we had came from Weirot. And Weirot said, do you think the oil price crisis, when do you think it's going to end and the Fed will solve the problem? First of all, I think it's going to take time for the oil price. It's not going to just come down that easily, because really, when you pull that much demand, that much supply out of Russia, and you try to shut down the access to that supply, it definitely causes prices to go up. Economics 101 is very simple. If you restrict the quantity of product into a market, the price is going to rise. And that's what COVID did. And that's what the war with Ukraine and all the sanctions are doing. It is restricting the supply of oil and gas into the market. That's going to cause it to rise. In addition, Economics 101 tells us that if you increase the money supply, then the value of money is going to fall and it's going to buy less. And that's the concept of inflation. So I think we're probably a ways away. I think the oil price could probably go up to $200. It's not something you can solve that easily. Imagine if the crisis with Ukraine and Russia right now ended. It's not like Russian oil and gas is just going to come flowing back into the economy. And will the Fed solve the problem? No, the Fed messes it up. What I would say is that most politicians, most senior people in government are not nearly as smart as they appear. And we've already seen Janet Yellen say she was wrong about inflation. And now, recently, she's saying that there won't be a recession. And I wouldn't believe that for a minute. So I don't think the Fed can solve the problem. And I just don't think higher interest rates is going to solve the problem of scarcity of product. All right, next question. So Puntrik says, what should we do with our U.S. tech, energy, Europe stock? Well, as you can see, we've reduced the U.S. down to 5%. So that should give you some indication right there that maybe reduce U.S. stock. Tech has been so strong. It's not as highly priced anymore. So I feel like there's not as much risk. And we can see that with tech, basically, they've maintained their profit margin. So I think there's some risk there, but I wouldn't say that it's a huge risk with tech. Energy, I would still keep a position in energy that's pretty strong. And like I showed before, I wouldn't go into Europe just yet. I just don't think it's time. All right, next question comes from Superco and says, commodities, when will be the time to leave from commodities? I would say somewhere between 1 and 12 months. I just don't know, but I'm willing to ride this thing as far as I could so that I can get as much return out of that. So I would say I'm going to stay on that for right now. Supercorn also says Thai baht weak versus US dollar. Any impact on fund performance? No. mainly the reason is because most of the currency is hedged. So fortunately for us, we're not going to be hurt if we get a currency going against us. So Supercorn also said, how do you view emerging markets in EU if World War III happens? It's going to be disaster. EU is going to be destroyed. America is not going to be hurt that much by World War III, but it's going to be the EU that pays the price. And so EU is going to hurt. And then also emerging markets will be hurt. We'll see inflation pass through. Inflation always peaks during wartime. And we'll see that inflation pass through. We'll also see that there's scarcity of products because farmers won't farm if they feel in danger. And therefore, you'll have scarcity like we're having now. So you haven't seen inflation the way it can be when we get war. And also remember that the country that is winning or the leading country's currency tends to go up and all other ones go down. All right. Tanat says, what do you think about China? Can China increase supply to the world? Well, they've got to get their people back to work. If they don't get their people back to work, then it isn't going to happen. So I've been really surprised at how extreme China's been. And they definitely have decided to take some serious economic pain. What we can see in China is that if you're ordering things from China, some of the factories are not able to run. In the past, before the COVID lockdowns in Shanghai or that type of thing, what we saw was it was still hard to deliver. So I think that China can increase the supply, but I'm not sure they can increase it with where demand is in the world. All right. And Supercorn says, gold is good for stagflation currently, but seems the market's running out of cash that pushes the US dollar to be very strong. What do you think? Yeah, well, when markets go into chaos, people tend to move into cash or take cash out of all of their assets. So it is possible that gold has some underperformance during that time as well as the market is concerned. But over a long time, gold has been a very good store of value relative to the overall market. But remember, we're not trying to capture some upswing in gold. We're just trying to prevent against major falls in the market. Tanat says arms industry. Yeah, unfortunately, the arms industry is the big winner out of all of this. They gain a lot of contracts, particularly with all these countries joining NATO in Europe. They're going to be using U.S. weapon systems for sure. Supergorn says the Japanese yen is soft sharply. It will hit imports while good for exports. How does Japan companies' composition in the stock market to balance this soft yen situation? Well, the good thing about Japan's stock market is they have thousands of companies that are trying to manage the situation. And obviously, if they can see their yen getting weaker, it's going to help their exports. But I'm not exactly sure if I can answer that question. It's not super clear to me, so I'm going to leave it there. All right. Yes, I like this one. Exciting. So Supercon says, if Republicans win midterm elections, any change in U.S. direction, such as stop support war or any major investments such as alt energy, if the Republicans win in November, I don't think it's going to be if. I think that the Republicans are going to win in November, and they're going to win a big majority in the House of Representatives and a pretty good majority in the Senate. That's my prediction as of this point. And when that happens, a lot of things are going to change. But unfortunately, the thing that's not going to change is war. Republicans and Democrats are now the same. They both support war. And remember, they're both funded by the war industry. They're also funded by the pharmaceutical industry. So that can tell you a little bit about what behavior they're going to have. Now, you asked, is there going to be any change? I would say, and you said alt energy. No, there's not going to be alt energy because the Republicans are going to say, we need real energy. We need to be able to go out there and drill for the oil and gas that we have in America, because now we have to start supplying Europe. So I think that will be a major change in strategy. And that could cause oil prices to come down substantially if the Republicans win the House. And that is an interesting point, because maybe that's the time that we stop our exposure to commodities, because Republicans take over and they say, we're going to let you drill to get us out of this problem. All right. Chanya says, my cousin in UK stated that the situation in UK is serious now for economic prospects. Yeah, UK is definitely in trouble. And there's a lot of food scarcity that's happening. And, you know, it is scary. If you go online and you go to YouTube, you can type in Ice Age Farmer. And Ice Age Farmer, the guy is phenomenal, but he talks a lot about how there are shortages that the government is actually causing. But yes, thanks for sharing that information. David Pasana says, when will this allocation update for phenomena plan? I'm waiting for it. It says, the new allocation that I presented today, you should have gotten it about a week ago. So if you have not made the switch in the allocation, you need to talk to your financial advisor right away to make sure that you're getting it and you're getting it on time, because we made that switch about a week ago. All right. Supawadi says, how much possible chance of stagflation is going to happen? What should we allocate our portfolios? Well, I think it's pretty high chance that we're going to have inflation and a slowing economy. And that combination is called stagflation. And the fact is that our positioning in the all-weather strategy is, for me, just about perfect for stagflation. 25% equity, 25% bonds, 25% commodities, and 25% gold. That is the allocation that I'm talking about here. So just to let you know. All right, let's continue on. And we've got more questions, great questions. Next question. Sita says, what are the investment proportions in commodities, oils, metal, food that you're suggesting? Well, I'm just suggesting that you do a commodity fund, basically, or commodity ETF if you can, but generally we're doing a fund. Now, we invest in the SEB Commodity Plus Fund, which is a master fund to the PIMCO Commodity Real Return Fund. And right now, I'm just looking at some information on that. It's about 36% energy and about 29% agriculture. That gives you the rough breakdown. As far as oil or precious metals, it's 17%, and industrial metals, 14%, and then livestock and food is about 4%. All right, remember, if you want to learn more about valuation, make sure you come into the boot camp. If you got questions, Alex or myself is online and we can help you with that. Okay, Dalin says, Sawadee Ka, Ajahn Andrew, why do you compare AWS with 60/40? What is the reason? Well, we could compare AWS to just the global equity market. Now, we wouldn't want to compare it, let's say, to the S&P 500 because we're owning stocks and we have allocations around the world. So it really wouldn't be fair to compare it against the S&P 500. So now, therefore, we compare it against the world equity. But if we compare it against the world equity, the problem is that the world equity is very volatile. It can rise a lot. It can crash a lot. And we're never going to be 100% in world equity. Generally, what we're going to be is maybe 70 or 80% in equity and the rest in bonds and commodities and gold. And so what we've done is we've used a 60/40 portfolio, which is 60% equity, 40% bonds. It's a static weighting that's rebalanced every time that we launch the new strategy. And the point that I would make is that it's a common term, 60/40. In America in particular, financial advisors use it a lot. They say, don't be totally exposed to the market, have 60% in the market and 40% in bonds. And that's the reason why we use it. It's not the perfect benchmark, but it is pretty good for what we're trying to do. All right. B-Book says the PPI just came out. Could it be a good sign that current inflation is at its peak? I didn't see what the PPI number was, but I assume what you're saying is PPI is starting to fall. If it starts to fall, that's a good sign. And producer price index is what we're talking about when we talk about PPI. And PPI is basically measuring the inputs into the production process and then what the producers are selling to. A great example is my coffee business where we're buying green coffee. So we're buying commodities. We're converting them into a finished good product, which is roasted coffee in a bag. And we're selling that to a coffee shop. And the coffee shop is selling it cup by cup. And then when they increase the price of a cup of coffee, that's CPI, Consumer Price Index. That's where that would fit in. And when we, as a producer that supplies that retail establishment or consumers, increase our costs, our prices, then that's the PPI. So if PPI is rising, it means that consumer prices should eventually rise. If PPI starts to fall, it means that consumer prices should start to fall. I don't know what the number is, so I can't really respond, but if it starts to come down, that's a good sign. Duk says, should we continue increasing investment or wait and seeing till the next signals? Well, with AWS, my objective is that you'll never have to ask that question again. Duk. What you do is just consistently invest in AWS and let me do that allocation of when do we go overweight equity? When do we go overweight bonds? When do we go overweight commodities? When do we go overweight gold? There's no point in you doing it if you've got me doing it myself and you can copycat what I'm doing. So that would be my suggestion. And since we just changed the allocations of our strategy, now is a good time to get that exposure. All right, we have 327 people I see online. I want to welcome everybody. We're going through questions. I've already been through the presentation. We've got about 7 to 10 minutes left, so I'm going to keep going through these questions and keep asking them. I will go over if your questions go over, but Obi says, what is your view about recession? How is the possibility? I think it's very, very high likelihood that the U.S. is going to go into recession, and when U.S. goes into recession, it can be very painful for the rest of the world. All right. CKMKDC says, due to the new start AWS port, should invest in all mutual funds as said by the financial advisor, or invest in gold plus commodity first and then wait for the others to get better. My advice in this case is copycat what I'm doing. Just copycat what I'm doing. We're spending 24/7 thinking about this strategy. And so CKMKDC, I would say, if you try to pick the allocations and I try to pick the allocations, the two of us are not going to have a better performance. Either you pick the allocations based upon your skills and your knowledge, or let me pick it, and then you're probably going to have a better chance of outperforming. Hopefully that explains my thought on how to do that. All right. Abigail, nice to see you. Abigail's in the Valuation Masterclass Bootcamp. She says, I'm not a client or investor, just a student here. Thanks for making this available to us as well. Very insightful to see portfolio management and diversification at work. And we are diversified for sure. May I ask, what's the target return for this strategy and how does it compare before and after the allocation change? The target strategy return is 6%. We are targeting 6% on average per year over a decade. In the past, it's been more than that. And when we've just rebalanced the portfolio this most recent time, the stock market started crashing and we had already switched out of much of the market. And so we were able to have pretty good performance. All right. Yosapon says, for those who can't DCA invest in AWS. Yeah, AWS is a good one for retirement people. All right. And what's that? I'm looking at your name in Thai, and I think it says Ponlamai. What do you think about NASDAQ's valuation, and are they cheap now? I would say that I was just looking at the profitability of the tech companies, and it's so high. I mean, it's so strong. They made so much profits in 2020, and they fell a little bit in profitability, but they're still so profitable. And what's the tech sector trading on? Like 15 to 18 times PE right now, I believe. It's not that expensive. Maybe it's 20 times. So from my perspective, the valuation of NASDAQ's not that bad. So if I was a new investor, yeah, I would consider start looking at NASDAQ. It still could come down more and it's very volatile, but the underlying performance of the tech companies has been strong and probably is going to continue. Okay. Panut Chanya says, Chaya, what's your opinion about how different of stagflation between 1970s and now? It's not much different. Oil prices really were a big driver of inflation at that time, as well as decoupling the dollar to gold caused the supply of dollars to rise, which also caused a problem with inflation. There's recently been a study that basically shows that if you adjust the inflation rate that we have today for the way they used to calculate inflation in the past, what you're going to find is that the inflation rate today is about equal to the peak of inflation in the 1970s. If it was apples to apples, we're almost at the same level of inflation as we saw in the 1970s. So I think it's very close to what we saw in the 1970s. Bas Mato says, do you think Fed is going to increase the interest rate up to 75 basis points on this coming Thursday, and why? Truthfully, I don't try to predict the movement of the Fed. I think the market is telling us that they think the Fed is going to raise interest rates pretty substantially. We saw that at about maybe 0.75. So I think it's possible. If you ask me, I think that the Fed's going to start getting scared. Powell has not been a great Fed chairman. He's messed it up many times. And there's a very serious problem now that we're facing a potential recessionary period. And as much as he wants to raise interest rates, he's not going to be able to bring down inflation. So I would say that they're probably going to raise rates. Maybe they raise them only 50 basis points because they're worried about recession. But it's very possible that they do it at 75 basis points, saying we want to get tough on inflation. But it won't have much of an impact on inflation. All right, I see that there's 329 people still on. You guys are awesome for sticking with me. We really only have about 2 minutes left, but I'm going to go over until we get all the questions answered. So feel free to ask any question, and then we'll end this. Yosipon says, for those who can't DCA, invest and also stuck with tech funds at peak levels, what would be your long-term advice for both AWS and tech funds? Well, this is part of the concept of diversification. Try not to ever have too much exposure to any one area, because I'm telling you, after 30 years of being in the stock market, you are always going to be wrong. I teach my students that you are always wrong. I call it y'all. The idea being, don't make too aggressive bets in one way or the other, because if you're wrong, it can really, really turn against you. So from my perspective, I would say that the most aggressive tech funds, like the ARK Innovation Fund, as an example, that are down massively, well, maybe they don't have a lot of hope, but selling at this point seems a little strange. I'm not sure I can give you great advice because I just don't know your situation. But I would say that the traditional tech companies actually are still very profitable, particularly the top 6 tech companies that I look at. All right, let's continue on. I'm going to try to get to all of them. Ansel, all are wrong. Inflation is still higher. Yeah, I think it's possible that inflation just keeps going higher. And it's already probably higher than what it feels like right now. Anusubu says, I have a few ports. Only AWS is green. Others are strong red. Let's fight for AWS. We're doing the best that we can. And you always said Fed will not raise the interest rates. Now they're going to raise it more strongly. I believe still that the Fed is not going to raise rates. Basically, when we talk about the rate rise for the Fed, we're talking about a tiny little rate rise. They were at 0, and now they've gone up a little bit. But I'm telling you, mark my words, in the next 3 months or so, you'll see the Fed start bringing interest rates down, because they simply cannot, the economy can't bear that type of thing. So I still think that they're not going to be able to raise rates. And what you're seeing is just a temporary thing. All right. So here we can see, is it possible to make profit with only pure technical analysis? What do you think about it? Yeah, I think it's possible. If you're an expert at technical analysis, you could do it. You know, you could be looking at momentum and other things. I think the critical thing to be successful with technical analysis is that you've got to have a good strategy for stopping loss, stop loss. Make sure you've got that. Okay. Uy Mom says, I like the way you answered about AWS. Thank you. You're welcome. I appreciate that. Sirada says, should I still follow DCA plan at the end of every month, or should I hold cash and wait? From my perspective, I would just do DCA every single month. Remember, bonds are like cash. We're 25% in bonds, and they're very short-term bonds. So it's almost like I'm holding 25% cash in the portfolio. Remember that gold is more, it's less like cash, but it still is a pretty, stable asset. So I would just do the DCA plan every month, and then let me do the asset allocation aspect of that. All right. So Chanya says, for AWS is a good tool for those who are preparing for unescaped retirement. However, mostly those who late 40s or 50 understand basic investment or invest for a certain time, but their risk profile is under 5 against your AWS at 6. How would you advise them? Well, I would say that if your risk is lower than 6%, like you want to get less return because you want to take on less risk, then I would just say just do cash and AWS. In the future, we're going to be able to answer this question with a better answer, but I can't tell you more about it just yet, but I will be telling you more about the options that we're going to bring to you soon. All right. Seiko Onitsuka says, do you think S&P 500 will decrease more or can recover soon? I would say it's probably going to decrease more. That's my perspective at this point. All right. Uy Mom says, it's just perfect. Just keeps investing and let Kunandru be your guru. Love it. Yes, I appreciate that. And we're working really hard every single day between myself and my team to try to provide you with good stuff. Salih says, will Joe Biden do anything to stop the recession? No. And even the things that he's going to do are going to mess it up. Don't count on most politicians to save us. Look at what's happening. He's trying to increase the amount of ethanol that has to be in petrol or in fuel that's in America. It's a disaster. Basically, we need corn. You know, right now we have a shortage of food. So it's kind of ridiculous. Chanya says, excited for the coming. Hey, I didn't say it was a port, but we've got some interesting things coming. So you'll learn more. Winnie the Pooh says, what's your point about gold? My point about gold is I think that we have a risk of the stock market crashing. If the stock market crashes, you're going to be happy that you're sitting in gold, even if gold goes down by 5 or even 10%. So really the gold is about protecting the downside. All right. I think we've made it through every single question that you guys have asked. I appreciate your time. It's 8:04 right now. I like to keep these at 1 hour so that we can get as much information as we can across, and then you can get back to living your lives. And really, I would wrap it up by saying that's the whole purpose of AWS. AWS allows you to live your life, to make your money, to worry about the things that matter in your life, and let myself and my team worry about the AWS strategy. And we then provide that to Phenomena, and Phenomena advisors and the investment committee review that, and then they provide it to you. So really, it's a chance for you to have peace of mind and get back to what matters most, and that is family, that is health, exercising, eating good food, and also making money through your job or through your business. So thanks, everybody. I appreciate your time. Erps, good to see you. Super Chuck says, bravo, boss. Yes, it's nice to see you here. And I want to thank everybody. We're going to wrap it up now. And I hope to see you again in a month when we review the performance. And in addition, for those of you who want to join the boot camp, we'd love to see you in the boot camp. Have a great evening. I'm going to go have a little snack and then go to bed. And I will see you in a month. Take care.